Hi everyone, welcome back to another episode of Providence Money Wisdom Podcast. I'm your host, Isaac, client advisor at Provident. Joining me today is Christopher Tan, founder and CEO of Provident. Hi Chris, great to have you back.
Hi Isaac, it's good to be back.
Right, so today we'll be talking about the latest BT article that you wrote titled Stay Invested for the Long Run, Think Again. Now with this title, it's a bit controversial, right? I think a lot of people might be surprised to see an article written by you that's titled like that. So maybe we can just start with what prompted you to write this article and why do you title it this way?
Actually, the title is a bit clickbaity, so-called, right? And the truth is, actually, I wrote a similar article several years back. If I'm not wrong, it was 2020, during the pandemic. The theme is the same, meaning to say that, this motherhood statement of staying invested. The good thing is that I had an interview yesterday, right? And I said the same thing, that it is good that actually now a lot of people are talking about staying invested for the long term, because I remember in 2008, when we were managing clients' money and when the GFC struck, right? Everybody, they were selling, and there weren't a lot of voices out there telling people to stay invested. I mean, had people stayed invested, they would have actually done much better than they built out at the peak of the crisis. So it is good that actually now everybody said will encourage others to stay invested. But my worry back then in 2020 was that, well, when we say stay invested, we say it without a proper context. So it is the same concern that I have today. Right now we are facing probably one of the biggest crises in our generation. We have never seen a trade war to this magnitude in our generation. And it's good that there are a lot of well-meaning people out there coming out to encourage investors not to panic, to stay invested. In fact, keep investing. When the market goes down, buy the dips and all that. But again, I'm afraid that without proper context, just getting people to stay invested and keep investing, we may actually do them a great disservice.
Right. So in your article, you challenge the conventional wisdom of just staying invested. But then again, how do we balance between not panicking, but at the same time not downplaying the crisis that you just mentioned?
Yeah. I mean, it's a good point, right? I mean, we should not go to either extreme. I mean, to totally panic, that will not be wise. But to be apathetic about it may also not be prudent. So I think we can take counsel from Morgan Housel. I think he has a very famous phrase.
My favorite author.
His books are all very interesting to read and a lot of wisdom actually. And one of the wise words that he has said, and I quote him, he said, save like a pessimist, but invest like an optimist, right? So I thought that is sort of like a good summary of how we should behave in a crisis. Is really balanced. I mean, to do nothing in a crisis when you're in a crisis really is not wise, right? You just say that, I don't care about it. I don't have to do anything. Everything should be in place. I don't think that's wise. So I think what Morgan Housel said hit the nail on the head, because you really should take a balanced approach of, in a crisis like this, you should expect the worst. You should really save like a pessimist, as if things is not going to turn around. Things are not going to turn around very quickly. We should be prepared for a very bad recession. We should be prepared for this trade war to be prolonged for a long period of time. We should be prepared just in case we lose our jobs. And even as a business, we should be prepared that it's going to hit our business. So save like an optimist. I think that's, or save like a pessimist. Beg your pardon. That is a very good advice. But as we have seen the history of the world, I mean, human beings, we are very resilient. We have gone through trade wars like this, not in our generation, but we have gone through very bad trade wars. We have gone through the Great Depression. In our generation, we have gone through the tech bubble burst. We have gone through the GFC. We have gone through the pandemic. The last pandemic was the Spanish flu. But our generation, we have that privilege. Very grateful that we survived this pandemic. And the world still chuck along, right? And the markets have still gone up. So have gone up. And so we should have that optimism. You cannot be an investor if you are pessimistic, right? So I think that is a very good balance. And perhaps I'll say the last thing here. About 6 to 7 years ago, I don't know whether you remember, but I developed a very simple way of explaining whatever we have been discussing for the last few minutes. And that's the personal money equation. And I remember I first presented it in 2020 during the pandemic to the general public at large. Right? It's a very simple equation, nothing rocket science about it. It's actually the time value of money equation, right? So the money equation, the personal money equation, starts with having an income, after taking away the expenses, after taking away your fixed expenses and variable expenses, whatever you left behind is your surplus. And the surplus, you invest it, well, hopefully you get the returns that you need to be able to achieve your goals. So there are two sides to the personal money equation, the left side and the right side. The left side is the personal, the short-term personal financial planning side. The right side is the long-term investment strategy side. Most people like to talk about the right side because the right side is the exciting side, it's the so-called sexy side of finance, the investing side, right? People don't like to talk about the left side because it is the boring side, the old financial planning side. But actually, it is the left side, the financial planning side, that makes a person rich. Right? The right side, just the investment side, just help a person stay rich. The right side is the side that you cannot control because you cannot control how markets behave in the short term. But the left side is the side that you can actually control because it's your own personal financial planning. And I think in a crisis, a lot of people want to tweak the right side. And they forget that actually the left side also deserves some attention. So just to answer your question, I know I'm like talking because a lot of things are in my mind right now. But if I use the personal money equation and if I use Morgan Housel's counsel, then I'll say that if you have been investing correctly, right, continue investing like an optimist. But on the left side, take care of financial planning side, take care of the savings side like a pessimist, right? Then your personal money equation will be balanced. Yeah, that's how you sort of like strike a balance between the both extreme ends.
Right, and just now you mentioned about preparing for a crisis. Of course, we are not sure where this is going to go, but it's good to make some preparation. But as part of some people's preparation is to tweak the right side. It's very tempting to tweak the right side of the equation, which is the investment side of things, right? I think when it comes to investing, it's a bit counterintuitive, right? In a way that in almost every aspect of your life, the more effort you put in, the more things you do, the better the outcome. But this is actually the opposite for at least the right side of the equation. But with that said, is there anything that clients should do, right, in terms of the right side of the equation? I'm sure, it's not. I think the setup must be right in the first place, right? So maybe you can elaborate more on that.
Yeah, actually, you have just said it, right? Because we always assume that when we speak to the public like this, we always assume that they are investing in the right things and they are investing correctly. So we always say don't tweak the right side, right? Just stay invested for the long term. But the point here is that there are many people out there who may not be investing in the correct things, right? So if you invest in single stocks, to ask you to stay invested for the long term, don't worry about how the markets is behaving, may not be wise, right? Because the companies that you have invested in, well, they may be doing very badly in this crisis, right? And some of the companies may even go down under if the crisis prolong, right? So that whole assumption or that encouragement to stay invested for the long term only works if you are investing in the correct things. So I think at this moment, it is good the investment response that you should make in this crisis is to do a thorough review of your investment portfolios. If you are investing in just single stocks, my encouragement to you is be a bit more globally diversified. You really don't know how long this crisis is going to last. You really don't know whether your companies will survive. And if you are just investing in a single country index, be it the STI, be it the S&P 500 or whatever, you never know which markets will be hit for a long time. I wrote in the article that in the 1930s, the trade war during the Great Depression, then we don't have the S&P 500. We only have the S&P Composite Index because the S&P 500 only came about in 1957. right? But in a way, it's similar, right? They built the S&P 500 taking reference from the S&P Composite Index. So the S&P Composite Index during the Great Depression, it took 15 years for them to recover, right? So if you are just invested into a single country index, you're not diversified enough. When you need the money, well, the markets may not have recovered yet. And actually that brought to mind many months ago, I said we had a similar interview. Because I wrote about the S&P 500 at the time. And of course, at the time, the S&P 500 were doing very, very well, and all that. And so I was saying that, no, don't just focus on one index, right? So we have been consistent. So I think it's good to take a review, take a good look at your portfolio right now and make sure that you are really globally diversified, because the next 5 years or so, we really don't know, right? Which markets will do well. Make sure that you are not just buying single stocks. A better way to do it is to buy thousands of securities, either via index ETF or index fund or non-forecasting fund. Yeah, so I think the investment response right now is make sure that you are investing in the right things. Make sure that the methods that the managers are investing is the right approach, right? It's not active, it's a bit more non-forecasting. And if you have done that, then yes, then you can hold steady, you can stay invested, you can keep investing, as long as your left side, just now we talk about your financial foundation is strong. Yeah, you can weather through this crisis.
Right. When it comes to country diversification, it's really about the mindset that we must have. I think if you're going for reliable returns, right? If your focus is to get the returns that you need, global diversification would make sense, right? I think when you make a country bet, be it in just buying Singapore stocks, buying US stocks, I mean, we cannot discount the fact that you can outperform a globally diversified portfolio, right? It's just that, that will be like trying to maximize returns, focusing on trying to maximize your returns. But what if you get it wrong? Right? Of course, if it's your play money, if it's money that you don't need, then that's, I think it's fine. Right? But of course, when we're talking about your retirement money, your non-negotiable life goals, like your children's education, I think focusing on reliability, accepting that yes, you will never outperform the country that is going to outperform in the future, but really just to accept that we really don't know which country will outperform.
In my generation, Isaac, we have this saying in Hokkien. It's called Tua Ho Tua Pai. If you are listening to this and you're my generation, you understand what I mean, right? Tua Ho Tua Pai means that is if I convert it to investment language, right? If you are right, you do very, very well. But you are wrong, you do very, very badly. So it's either extreme. So I guess you have to really consider whether you want to take this approach to investing, especially for your very important goals. Do you want to take this approach? It's binary, it's either right or wrong, right? So taking a very concentrated position may lead you down that direction. I mean, I would say that, I don't want to be judgmental, but I'll just say that that's definitely not Providend's preferred way of approaching investing.
Right. And also there's a lot of sayings out there in investments like buy the dip, stay invested, be greedy when others are fearful, be fearful when others are greedy. I think it's also important to know the context of it. You can look at things like maybe a crypto, maybe a single stock, and you see it falling sharply, right? And you can actually, some people use these sayings to encourage themselves to buy the dip and to stay invested. But I think that's why it's so important that yes, there's a lot of wisdom in all these saying, but it's really to understand the context behind this saying rather than just applying it across all the asset classes, because you could find yourself really just buying into something that eventually severely underperforms or even collapses.
That's really my worry when I wrote this article, because like I said, I've been hearing a lot of advice going out there, stay invested, buy the dips, and all that. My biggest problem is that I'm not sure whether people expect the recovery to happen very fast, because this recency bias, right? Over the last 5 years or so, whenever the markets crash, it recovered very quickly, right? even if I go all the way back to the 2008 GFC, of course, no one expected it to recover so quickly. But the 2008 GFC, it was so serious, I still remember December of 2008, the world is like going to collapse. If I don't know what you were doing back then, 2008, but I will tell you it's very, very scary because you wake up every morning, you see headlines, you see, sometimes headlines, they sensationalize, right? It's like the world is coming to an end because in truth, the world has lost liquidity. We don't have money anymore, right? And money is like blood in the body. Money in the financial system is like blood in the body. You have no blood in the body, you cannot go on. You have no money in the system, no security, policemen will not be paid, the military will stand down, aircrafts cannot fly, right? But then 6 months later, in April of 2009, the markets recovered. So I'm just concerned that people think that, this is just going to be like another of those crises, right? But the key difference, and again yesterday I was asked this question, what's the key difference? The key difference is that in all these crises, the countries are all coming together and they want to work out a solution, whether it be the pandemic, the GFC, people want to work out a solution. But this crisis, you have countries all fighting each other, right? And what happens if this is a repeat of the 1930s trade war? I hope it will not be, which is what I wrote in the article. But what happens if it goes on for the next 5, 7, 10 years? 1930 was 15 years before the markets recover. And so today we encourage people to stay invested, buy, keep investing, but they actually cannot tahan 10, 15 years, right? And halfway through, they give up. They're just so fearful and they give up and they actually lose money, right? Yeah. So that's one concern that I have. And the other concern that I have is when we push people to stay invested, we say, we give general advice, and if we are very influential, people listen to the advice, but that advice is given without understanding a person's personal situation, right? A person's health may not be good, and we keep pushing them. I'm not sure whether that's the best thing to do. So I mean, yeah. So I get a bit concerned, when I know I sound really oxymoron. On one hand, I am happy that people are not panicking, but on the other hand, I am also concerned that people might be overly optimistic because of recency bias. In the article, I quote Admiral Stockdale's experience in Hanoi Hilton. I thought that's an excellent example of why we need to confront the brutal facts, but yet maintain unwavering faith. And again, when we just say confront the brutal facts, but maintain the unwavering faith, we need to understand the context. And that's why in the article I wrote the full context of why Admiral Stockdale said that. He is not saying confront the brutal facts, but have faith that we're going to get out very quickly. He actually said the people who died, they are the optimists because they expect to get out Christmas, Easter, Thanksgiving, right? Yeah, so I just want to sound a warning alarm so that people will, okay. Again, going back to Morgan Housel, thanks to him, you invest like an optimist, but please be very pessimistic when it comes to protecting your financial foundation.
Have you been overwhelmed by market uncertainty in a landscape crowded with misinformation? Our new ebook, A More Reliable Way to Get Enough Investment Returns, is here to help. Each chapter is carefully curated to help you overcome confusion and empower you with knowledge that prioritizes reliable returns, guiding you towards a fulfilling investment experience. Check out the link in the show notes to download a complimentary copy of the full ebook today. Thank you, and let's get back to the episode. Right, so just earlier you mentioned that the recovery started after 6 months, but actually it took 5 years, I think, to eventually go back to where it was. But I think even during the time when it's going back up, there's a lot. The headlines will be like, this is a false rally and all that kind of stuff.
Exactly, that was 2209. Yeah, when it started recovering in April, there were a lot of market commentators that said, no, fake.
Yeah.
It's going to come down again. But then S&P 500 went through like a decade of rally,
Yeah. Yeah. So I think when it comes to the financial planning response, right? It's I think this article provides a very good balance, especially with the content that we are actually putting out in recent times because of this crisis, right? I think for us, we always focus on getting our clients to stay invested and all that, but we also don't want that overcorrection in the pendulum in a way that we don't want people to be so excited about buying the dip that they're maybe tapping into their emergency funds, right? Just to buy the dip and all that. So I think it's very good that you touched on the financial planning response. And the thing about that you wrote in the article is that our well-being should be prioritized, right, in a crisis. So and it's really, even though it's not ideal to divest, to liquidate during a crisis, but if it's affecting your mental health, your physical health, your sleep at night, and we all know that crisis can be a quick recovery, like what we experienced in 2020 for the COVID crisis, or it could be very long drawn, like the multi-year bear market that we experienced for the GFC. So maybe you can elaborate a bit more on why we should, why is it so important, even though it's not ideal that we liquidate during a crisis.
Why taking into context or taking into consideration well-being is so important, is it? Well, before I answer that question, because when you said that we've been putting out a lot of content, actually the fact is I'm a bit guilty of the fact that we have not put out a lot of content to the general public. If you think about it, yes, we put out a lot of content. We did a lot of stuff. We did a webinar. We sent out email updates. They are really more for our clients, if you think about it. And for the last month or so, I think we have been very busy focusing on taking care of the clients. I mean, that has to be the case. Our clients have to be the priority, right? I mean, we should not be going out there and speak to everybody and then neglect our clients. Even though, thankfully, you're a client advisor, you know you speak to your clients, right? Our clients are almost every one of them, they are okay, right? It is only in the recent 1 week or so we started putting out contents to the public, and actually I'm glad to that we have done this, because it also allows us to hear, what other people have been saying already. I mean, there are people who are doing sufficiently good work, and we should not repeat it. But after hearing what people have said, it's good for us to then say, okay, there are some gaps maybe you can plug. So this is probably one of the first few public content, like podcasts, that we put out during this trade war crisis. Okay, so back to your question on why. Because our physical wellness, our health, and I'm not talking about financial health, I'm talking about our physical health, which can be our emotional health and our mental health, they do affect a person's ability to take risks. Right? A person's ability to take risks is not determined just by time horizon. I've seen a lot of literature put out there. A lot of times people ascertain a person's ability to take risks as the time horizon they have. But actually there are many things that affects a person's ability to take risks, and the physical well-being, the mental well-being, the emotional well-being, is these are the factors. And so if a person is physically unwell, mentally unwell, stressed during this crisis, a lot of things are going on in his life, I'm not sure whether the best thing for him to do is to stay invested. Right? If he takes the money off the table, yes, he may incur some losses, but at least he's healthy. I don't want him to die of a heart attack. And I shared that story of a real client back in 2008 in the article. Well, some people may say, but wouldn't you have ascertained that at the beginning of the work that you have done for your clients?
Exactly.
But the thing is, things change, right? I mean, something that we do 1 year ago, 2 years ago, things might have changed. Certain things might have gotten very difficult for that person back at home. Things might have become very difficult at work. He could be potentially facing a retrenchment, right? So we don't know, and we cannot assume that a person is well 6 months ago, 1 year ago, should be well today. And that's why planning is in a way fluid. It's not fixed, right? And that's also why, we have a lot of things to say about risk profiling. It is insufficient just to do a pen and paper risk profiling questionnaire, right? Because that 5-7 whatever questionnaire, right? Even if it's done professionally, only measures a person's psychological willingness to take risks. And even that is inaccurate because a lot of things affect a person's psychological willingness to take risks. Investment knowledge is one, life significant events, this person's experience in the past in investing. A lot of things go into that. And you cannot determine that just by a piece of paper. Well, we have to do it because of compliance, but it's not enough, right? And therefore, we need to consider a person's ability and even a person's need, right? And in the article, I said that, and we have done that for our retiree clients, right? Because of last 10 years of good returns, if they have already reached their goals, there's no need for them to take risks. They should sell out. What happens if the crisis becomes longer and 1 year, 2 years later, the amount that they have goes down, right? If they have already hit the goal or near their goal, I think it's a good time to sell out. So, yeah, so again, back to this whole thing about staying invested, I think it's just too general and we just have to be very careful what we say.
Right, and I always say that you only truly know your risk profile in a crisis, right? I think when things are hunky-dory, everything is going well, you're like, oh, I can take risks, you know?
The very crude way of saying it is when the tide goes down and you know who they never
Who's
wear their
swimming
swimming
naked.
trunks. Swimming naked.
Yeah. So I think it's really true. I think during a crisis, when you actually suffer the financial losses, or rather at least on paper, but people often forget that in a crisis, there are so many other things that are going on as well. Your job security, you could be seeing your colleagues being laid off, or maybe you are secured, but maybe your spouse is not secured, right? And that will actually affect
that's a good point.
And,
the spouse side,
and it probably something that you didn't really think about too much when you were doing the initial setup. But I think that's why it's very important that we focus on the things that we can control, which is the left side of the equation. How secure is your job? How secure is your spouse's job? Should you be buffing up the emergency savings instead of just focusing on trying to use whatever liquidity you have to buy the dip, right? So all these kind of things have to be considered during a crisis.
And that's why we are so unwilling, to take on a client when a client comes and say, I give you this sum of money, don't ask me anything else, don't do the plan for me. We're so unwilling to do that. Because if there is no plan as to be the base, to be the basis of the advice, when things become really tough like now, there's no basis of the advice, right? There's nothing to fall back on. I mean, I don't know you well. I don't know your situation. I don't know your financial situation. I don't know your personal situation. There is no plan. And that's why a lot of times, when we have prospective clients will come and say, okay, no, I'm just going to give you $1 million, $2 million. You don't ask me any more questions. No, just invest the money, earn the returns, right? We usually almost say no. We don't want to take on a client if it's just like that. Because if I cannot hold you through the crisis, I don't want to take your money.
Right. So there's two sides of the equation, but the interesting part about the article is there's one more response. Do you remember what that was?
Live
response, right? So I think that is really interesting because you cited your own experience after the GFC, right? For yourself, you cut back on your lifestyle, you took away all the fluffs that you don't need. But the surprising thing is, of course, we all know what happened after that. Markets recovered. Provident as a firm also has grown from strength to strength. And I believe you are in a lot better place now as compared to 2008. But you choose to stick to the simple life that you adopted in 2008. So maybe you can just share with our listeners why this is so.
Yeah, now that I've become a billionaire, right? Okay, I'm just kidding. I'm just kidding. Well, yes, definitely things have become a lot better since the early days of Provident and since the GFC of 2008. There's a very popular saying. I don't know whether you have always heard the senior say this, right? And that is, luxury once enjoyed becomes a necessity. Have you heard of this phrase before?
Yeah.
And it's true, right? Luxury once enjoyed becomes a necessity. My own take, my counter to that is, simplicity once appreciated becomes a sanctuary. I think once you enjoy simplicity, you find rest. And once you find rest, you don't want ever to go back to the good old ways of chasing after things, where you have no peace, You may have a lot materially, you may have possessions, but actually you really have no peace. In the work that I do, that we do, especially in the area of legacy planning, I mean, I've spoken to very, 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 very wealthy individuals. Not all of them became clients, but the one thing I know, and it's not new, actually the more a person has, the more worries a person has. Right? So luxury once enjoyed become a necessity. It's true. You want more and more and more. It's never enough. But simplicity, once appreciated, it's really a sanctuary. It's a place of rest. And so it's not just me, really. All the founders, the founding team, right? There are 6 of us. If you look at the lives of the rest of the founding members at Provident, they all live very simple life. They all stay in public housing. They all drive simple cars. Most of us actually, we take public transportation to work. But I just want to say this, because don't get us wrong. We are not saying that you should not stay in a private condominium, you should not stay in a landed property, you should not drive a Continental car. If you do all these things, shame on you. You're not living a simple life. No, we are not saying that. Everything is personal and everything is relative. If you are a billionaire and owning a GCB is just a fraction of your wealth, you're living a very simple life. If you are a multi-millionaire and if you are driving a BMW, it's a fraction of your wealth. And you know, that car brings you joy and is a fraction of your wealth. What's wrong with that? Right? So please don't get me wrong. I'm not being judgmental and I'm not being prescriptive. I don't mean that everybody should go and move to a public housing, a HDB, or be very tough, always look down, take the train. I'm not saying that. Everything is relative. But for us, I mean, the founding team, we are financially okay, but we are nowhere near multi-millionaires, right? So for us to keep to where we are today, in a nice HDB, renovate it nicely, a car that brings us around, not in debt, it gives me a lot of peace. And one last thing I'll say, it helps me and help the founding team runs Provident properly. Because the decisions that we make at Provident, we don't have to do it to support our lifestyle. I don't have to do it just because I have to go and pay the mortgages of a very big house, to pay for shiny objects. We don't have to. We can make decision that is in the best interest of the firm, that is in the best interest of the clients, without being held hostage by money. So why do I want to go back to that lifestyle of luxury when I have already found rest?
Right. And I can see how this influenced the way that you advise clients, how you tell us to advise clients. There's a lot of focus on things like finding your ikigai goals, right? Your non-negotiable life goals, life purpose, finding meaning in life and all that. Because all this is actually the important things that make you happy, not just about financial goals and achieving your financial goals. So Chris, could you expand a bit, about how knowing your ikigai goals, knowing your non-negotiable life goals, really influence the way that we advise our clients?
Yeah, I think since 2010, Provident has advocated the philosophy of sufficiency. Yeah, and of course, over the years, it has become a lot clearer and clearer for us. And we have been advocating it and educating and reminding our clients. Many of our clients who come to us, they are attracted to us because of the fact that they too believe in the philosophy of sufficiency. But ultimately, this has to play out in the plans that we do for them. And so all our planning approaches, they are anchored on the philosophy of sufficiency. But, not to belabor the point, I'll just simply say that the whole philosophy of sufficiency is about reducing all the distractions and noises in a person's life into its irreducible minimum, meaning to say the non-negotiable life goals. And once we know what are our non-negotiable life goals, we arrange our financial affairs to support these goals. And so at Provident, that's our job. Our job is to help our clients reduce all the distractions in their life to their non-negotiable life goals. Okay, and then we, in the area of investment, we use an approach that will give our clients the highest probability of success. Why must it be that way? Because it's non-negotiable life goals. We cannot fail. So we don't use an approach that gives our clients the maximum returns. We use an approach that will give them enough returns for them to achieve their life goals and in the most reliable way. So that's why highest probability of success. In the area of insurance, for many years we have said that, and you can see why it's anchored on the philosophy of sufficiency. We have a saying in insurance planning that buy as much insurance as you need, but pay as little as you can. We've been saying that for, ages, almost 20 years, right? And that's anchored on the philosophy of sufficiency. Buy as much insurance as you need. Don't overbuy. Pay as little as you can, because there is a cheaper way to own insurance than buying whole life and ILPs, and all that. One last example, maybe in the area of legacy planning, we have written and spoken quite a bit about that. And we always say that, as part of the philosophy of sufficiency, because if I reduce it to its irreducible minimum, it's about helping our clients find their non-negotiable life goals. Then we arrange our financial affairs to support our life goals, right? So if we summarize that, it's about making first life decisions before making money decisions. And in legacy planning, we want to help our clients know what are some of the life decisions in legacy planning. What is actually the message they are trying to send? What is the legacy they are trying to leave behind? Because without the message, without the human aspect, without this consideration of what are the values I want to pass, we talked about it in the last episode, the previous 2 episodes, right? You are really just we are really just doing estate planning. You're just really leaving behind an inheritance, right? So in legacy planning, we first want to help the client make these life decisions on what are the values they want to pass behind before they start to build structures, whether it's trusts or wills or whatever other things to support that legacy plan. Right? So all these planning methodologies, approaches, they are actually anchored on the philosophy of sufficiency. So that's how it's being played out.
And that's why our advisory process is as long as it is, right?
Very long. Sometimes maybe too long. But I think we find it very hard to cut down further and still be able to do good work for the clients.
Okay. Thanks so much, Chris. I think with that, we can end today's episode. So really, thank you so much for your time once again.
Welcome. Pleasure.
Right. To all our listeners, I hope you enjoyed today's episode. If you like this episode, please follow our podcast and subscribe to our YouTube channel if you haven't done so already. As always, thank you all for listening, and I'll see you all in the next episode. All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Provident Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Provident Limited.